Good morning, and welcome to today's webcast, Navigate Research and Experimental Expenditures Guidance. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, with that, I'm pleased to introduce today's presenters from Moss Adams, Travis Riley, partner, and Josh Harbin, senior manager. And with that, I'll turn it over to Travis to get us started.
Hey, good morning, everyone, or good afternoon, depending on where you're joining us from. My name is Travis Riley. I'm a partner here at Moss Adams, and my focus is on research tax law. So that includes Section 174 and Section 41 of the Internal Revenue Code. I've been 100% focused on R&D over the past 17 years, working with clients in many different industries, and lately spending a lot of time helping our clients to figure out how to comply with the new R&D capitalization rules, while also helping to minimize their overall tax burden. R&D capitalization, it's really one of the top issues that many of our clients have been facing over the past year. I also spend a lot of time helping clients navigate the R&D tax credit, which is also something that always seems to be changing and evolving over time. So looking forward to sharing some of this knowledge and experience with you here today. Josh?
Hi, good morning, everyone, or good afternoon. Similar to Travis, I have been working in the R&D tax credit Section 174 space my entire career. Just over 10 years now, working with companies of all sizes and across all different industries. As mentioned, I'm a senior manager at Moss Adams in our R&D tax services group, and have a lot of the same responsibilities that Travis just mentioned with serving our clients.
All right, so today we're going to be diving into the world of R&D capitalization under Section 174. And we're going to talk about the recent interim guidance issued by the IRS, which significantly impacts how companies account for their research and experimental costs and their software development expenditures. The new guidance is something that we've been eagerly anticipating. And while we had hoped that it would have come sooner and we were having this discussion a year ago, the old saying goes, it's better late than never. So right now, I think we're grateful that we have new guidance. It's been tremendously helpful for many of our clients, and we look forward to sharing our insights. So just a brief agenda here. We'll we're going to begin by providing an overview of Section 174 and the changes brought about by the Tax Cuts and Jobs Act, or TCJA. Next, we're going to go on and explore the midpoint and short taxable years, highlighting the role of the midpoint of the taxable year in the amortization of R&E expenditures. We'll also address short taxable years in that section. And then we're going to go on and clarify what constitutes R&E expenditures and discuss the different allocation methods outlined in the new guidance. After that, we're going to examine the impact of these changes on software development and how that's been defined for capitalization purposes. We'll also explore research performed under contract, providing insights into how contracts affect the treatment of R&E expenditures. And then finally, we'll touch on some of the other guidance around dispositions, long-term contracts, and cost-sharing arrangements, talking about how those sections apply to certain taxpayers. Our goal is it's really to provide you with a general understanding around some of these key issues. And so we're going to get started kicking it off with an overview of Section 174. All right. So before we take a closer look at the new guidance, I want to take just a moment to provide a little bit of historical context. So going back in time, back to the early 1900s, there was a lot of uncertainty in how taxpayers were supposed to account for their research expenses. And that uncertainty was addressed by Congress in 1954 with the introduction of Code Section 174. Under the original 174, companies had a choice. They could either deduct all of their research costs immediately, or they could spread the cost over at least 60 months. And what that did is it eliminated some of those long-standing uncertainties. And in 1954, it's really remained that way for almost 70 years up until recently. So when we fast forward to 2017, that's when we have the Tax Cuts and Jobs Act being signed into law. So if you look at that, I think Congress was searching for a way to pay for tax cuts and eliminate the corporate AMT. And what they found is that they could raise about, I think, $120 billion over a 10-year period by putting this into place and requiring companies to capitalize their research costs. But so we had a gap there. The law didn't take effect until 2022. And during that gap, I think many people in the tax world, I think even myself, and a lot of people within the government, we believed that this law was going to be repealed. As a matter of fact, I didn't talk to too many people that didn't think it was going to be repealed. But so far, that has not transpired. And taxpayers and IRS, they're doing the best they can to play the hand that they were dealt. So for tax years beginning after December 31st, 2021, taxpayers can no longer immediately deduct their research expenses. Instead, costs that are incurred for research performed within the United States are charged to a capital account, and then they're deducted over a 5-year period. While at the same time, costs that are incurred for research performed outside the United States, those get deducted over a 15-year period. And the new law, so it also comes with a mid-year convention rule. So essentially what that does is it extends the recovery period out for another year. So instead of 5 years, it's really a 6-year deduction. Instead of 15 years for foreign, it's really a 16-year deduction. Then another significant change, very significant, is that all software development costs are now 174 costs that have to be capitalized and amortized under this new regime. This is a really big change. It impacts almost every tech company out there. And I'll tell you, it's never fun having to explain this to companies that are just finding out from their outside tax preparer, and they're calling us up and and they're asking us questions like, hey, is this for real? And the answer is yes. So another change here is that the new law does not allow an immediate deduction when there is some sort of disposition, retirement, or an abandonment. This is one where we've also been fielding a good number of questions, and we're happy to see that that was also addressed here in the new guidance. I know with respect to that, there was a lot of different positions being contemplated around that over the past year. We've seen a lot of that, circulating. So now that we have more of a foundational understanding of Section 174, let's dive into the key sections of Notice 2023-63. All right. So 1 week before the September 15th tax deadline, if you're a pass-through entity on extension, the IRS dropped 45 pages of guidance on Section 174. As I mentioned before, the guidance was widely anticipated, and while the timing was not optimal by any means, we're grateful that we received it, and it did address many of the questions that we were receiving and considering on a daily basis. So, September 8th, 2023, the Department of Treasury and IRS issued this notice. It's interim guidance. It's Notice 2023-63. And what it did was announce plans to propose regulations addressing 174 and to provide taxpayers with interim guidance. The forthcoming proposed regulations are expected to apply for taxable years ending after September 8th, 2023. But taxpayers can choose to rely on the notice for taxable years beginning after December 31st, 2021. However, there is a catch. If you do choose to adopt the guidance, then you have to apply all of the rules within the notice, and you have to apply them consistently. So, in other words, you aren't allowed to just pick and choose sections that yield the most favorable outcome while ignoring some of the others. I think it's also important to note that the notice only applies to the new 174, so the TCJA 174, not the old 174 that applied for taxable years beginning before January 1st, 2022. So just going forward. Just yesterday, I saw news that an IRS official came out publicly and said that they are expecting to issue proposed regulations early next year. So early 2024, which I would say that's on track with our expectations and also welcome news. It's also important to note that the IRS is soliciting comments from the public around this notice. And those comments, they're actually due exactly 1 month from today. So that means comments need to be submitted by November 24th, 2023. So if you're looking at the guidance, you see something that you didn't like, or maybe if you have ideas on safe harbors or simplified methods, then now is a good time to make sure that your voice is heard. You will have another opportunity next year after the proposed regulations are issued, and I expect that we'll see a lot of comments, and I'm thinking that we're going to see some really diverse perspectives on this topic. Truthfully, the main comment that we hear the most is that this whole idea of capitalizing your research costs disincentivizes research, and it's not great tax policy. I mean, it's hard to argue with that. But the IRS doesn't have control over the laws passed by Congress. And, it really seems like they're doing the best they can to balance all the various input that they're receiving from a lot of different parties. So I know, internally here at Moss Adams, when I surveyed my team, and I asked them all, I asked them for their main takeaways on the notice or their key takeaways. And one of the consistent themes that emerged is that, they felt the guidance was really helpful. That was the consensus. And also people are eager for more guidance. So 45 pages wasn't enough. We're expecting more than that. And really the reason that we need so much guidance is that Code Section 174, if you look at it, it's really 4 paragraphs long. And now much of the regulatory guidance and the case law that previously existed, I mean, that's pretty much outdated. So sorry, I know that's a lot of information here on one slide, a lot of upfront information, but wanted to make sure that you had a really good understanding of the big picture before we dive into all the details. And so with that, we're going to transition into the next section and address some of the mechanics that have been prescribed by the IRS.
All right. Thanks for that overview, Travis. So the first point of guidance in Notice 2023-63 essentially clarifies that Section 174 is required for R&E expenditures, and that the amortization period is ratably over that applicable amortization period, beginning with the midpoint of the taxable year. That phrase, applicable amortization period, is a new term that's defined in the guidance itself as a 5-year or 60-month period for domestic research and 15-year or 180 months for foreign research. Foreign research meaning when R&E activities are performed outside the US. Now, the Section 174 modified code language itself didn't specify the 60-month or 180-month component, rather just stated the 5 or 15-year element, leaving some taxpayers to question how to treat short years and if an accelerated recovery might be available through short years. The clarification on the number of months provided in this guidance isn't necessarily surprising by any means, and is consistent with other areas of the code, such as amortization for intangibles. So digging into what the midpoint is and how to determine it for a short year, the guidance essentially provides that the midpoint is the first day of the 7th month of the taxable year in which the R&E expenditures are paid or incurred. So for example, midpoint for a calendar year taxpayer would be July 1, and a midpoint for an April 1st to March 31st fiscal year end would be October 1st. Now for these full 12-month year examples, it was relatively straightforward already, but again, where taxpayers had more questions and uncertainty was in relation to short taxable years. So digging into the short taxable year component, the guidance essentially provides that the first step in determining the midpoint for the short taxable year is determining the number of months in that year. So if a short year includes a partial month, meaning it ends at some point in a given month, the entire month would be included for that first applicable year and is not counted twice in the case that there's 2 short periods simultaneous or subsequent to each other. The midpoint of the short year is the first day of the midpoint month. So the second step in determining what the midpoint month is for the short year, or the second step is determining that midpoint month. So now we know the number of months in a year. What is the midpoint for that year? The midpoint for a short taxable year with an even number of months is determined by dividing the number of months by 2 and adding 1. So for example, in a short year with 10 months, the midpoint is the 6th month of that short year and would be calculated as 10 months divided by 2 plus 1, you're at the 6th month. The midpoint for a short taxable year with an odd number of months is the month where there's an equal number of months before and after such month. So I know a lot of this is a lot of wordy language, but it's fairly straightforward once we go through an example here in a moment. But in illustrating the odd number of months, an example would be for a short year with 7 months, the midpoint month is the 4th month, since there would be 3 months before and 3 months after. And that 60 or 180 month amortization period would begin at that determined midpoint. So going through just a quick example here to illustrate those concepts, think a taxpayer with a calendar year that incorporated and began operations on October 17th, 2022. that taxpayer's short year is treated as having a 3-month taxable year. So that would include October, November, and December. And since there's an odd number of months, the midpoint will be November 1st, since there's 1 month before and 1 month after. And with that, I'm going to hand it over to Chad to do our first polling question.
All right. Thanks, Josh. And we have our first polling question for the day. Did your company or client have 174 R&D expenditures for the 2022 tax year? A, yes. B, no. Or C, I don't know. We'll give you about 40 seconds here to answer. Just remember, you need to answer at least 3 of the 4 polling questions today to receive your CPE credit, just by selecting the answer and hitting the submit button.
And just a reminder, please feel free to submit questions. We do have a lot of content today, but we will definitely follow up with you to address any questions you might have.
All right, getting to about the 80% mark here. Give you about another 5 to 10 seconds to submit your answers. All right, I'm going to move it on to the results slide here.
All right, so 66% said yes, they did have R&E expenditures for the tax year. So hopefully some of this guidance was helpful for you in determining this. So now let's transition into some of the meatier sections of the guidance, starting with what types of activities and expenditures are considered R&E. So the guidance confirms there's really 2 types of R&E for Section 174. Those activities and expenditures that satisfy the requirements of Treasury Regulation 1.174-2. Meaning those expenditures that are in the experimental or laboratory sense, intended to discover information that would eliminate uncertainty concerning the development or improvement of a product. This is kind of our previous definition of Section 174 and what it meant to be an R&D expenditure. So that's part 1. The second part is all software development, regardless of whether those costs meet the requirements within 1.174-2. So there's 2 key components there. We have the original 174 element of R&E, and also now all software development, regardless of whether it meets those requirements in the regulations. This isn't really a surprising clarification, but there were some positions floating around in the industry that software development would only be included if it met the requirements in the regulations. But this guidance makes it very clear that software development is its own category, even if it doesn't meet the requirements in those regulations. And we'll get into how the notice defines software development shortly. So one of the biggest areas taxpayers had uncertainties on prior to this guidance was understanding the extent of the incident to language in Section 174 regulations. This essentially says that all costs incident to the development or improvement of a product are included in Section 174. Now, incident to isn't defined in the regulations, and taxpayers were left to interpret what that meant in the context of their R&E expenditures. The guidance here provides some clarity through examples on what those types of costs would be, but did specifically state that the examples were not an exhaustive list, meaning more types of costs may be applicable to Section 174 than the examples that were provided in the notice. Providing a non-exhaustive list, again, isn't really surprising here. It wouldn't be reasonable for the IRS to provide or address every type of potential expense for every type of industry or client. So adding that caveat to the notice wasn't really unexpected. Digging into some of the examples provided, the first one being all labor costs for full-time and part-time employees and contractors that perform, supervise, or support R&E, excluding severance pay. So this would include all your regular overtime, vacation, holiday, and sick pay, stock comp, payroll taxes, pension costs, employee benefits, and payments to supplemental unemployment benefit plans. For many taxpayers, the labor costs will make up the largest portion of your R&E expenditures, but that could vary depending on, obviously, the industry and the client fact pattern. The next category here is materials and supplies, including tools and equipment that are not depreciable under Section 168. So these are going to be tools or materials that are used or consumed in the performance of R&E activities or in the direct support of R&E activities. So again, looking at these two categories as the first two listed in the notice, nothing really unexpected here with either of these, but it is interesting that for the labor costs guidance to say specifically only supervise as opposed to directly supervise, which is the language we typically see from an R&D credit perspective. And it also, we have the directly support language included. So what this might imply is a higher level employee beyond the first level supervisor may be included for Section 174. All right, so some more examples here provided in the guidance. The next one being various cost recovery allowances. This would include depreciation, amortization, depletion allowances with respect to property that's used in the performance of R&E activities or the direct support of R&E. Importantly, this would include allowances in the tax year for property placed in service prior to the tax year. So you're looking at the allowance for that specific tax year and whether or not it might be included in 174. Examples of these costs might include depreciation with respect to a piece of equipment used in the performance of R&E or an allocable portion of depreciation with respect to a facility used for R&E purposes. Costs of obtaining a patent, such as attorney fees, expended in making or perfecting a patent application would be applicable, and travel costs for the performance or the direct support of R&E activities. Something to note here, this doesn't necessarily mean all travel costs for an R&D department are automatically going to be included in Section 174. There might be travel for training or sales conferences or other non-R&E related activities that may not be applicable for Section 174. And then the last category contains most of your overhead related items and is labeled as operation and management costs. And this would include items such as rent, utilities, insurance, taxes, repairs and maintenance, security costs, and other similar overhead costs for facilities, equipment, and other assets used in R&E. Similar to the comment about travel costs, for these expenditures to be includable, they would need to be incident to the performance of R&E. So most of these are likely going to be based on some form of allocation to be included in Section 174, which we'll talk about in just a moment. Because of how broad incident to can be interpreted, I wouldn't say any of these expenses themselves are a surprise if they were connected or incident to the R&D activities. The key is determining that connection and determining how much of it is allocable to Section 174. So moving on then to some other welcomed guidance around what is not permitted or required to be included in R&E. The first category is costs paid or incurred by general and administrative departments that only indirectly support or benefit R&E. So for example, payroll personnel in preparing salary checks for R&E employees, human resources personnel who hire research personnel, or services of accounting employees who might be doing accounting for research projects. This is welcomed clarity. Again, because incident to is such a broad term, there was uncertainty as to whether the IRS would consider these indirect G&A costs part of 174. Some other items that are excluded from the R&E Section 174 categories would be interest on debt to finance R&E, cost to input content into a website, cost for website hosting, cost to register an internet domain name or trademark, other costs that are listed in the -2A6 regulations under 174, which would include quality control testing, efficiency surveys, management studies, consumer surveys, advertising and promotions, and acquisition of another's patent model or process, and also any research in connection with literary, historical, or similar projects. So those were the items already excluded under Section 174 regulations. And then lastly, amounts representing amortization of R&E expenditures. So now that we know all of the types of costs, or at least examples of those types of costs, determining what the Section 174 expenditures are is going to be based on allocations in many different incidents. So taxpayers must allocate costs to R&E based on a cause and effect relationship between the cost and the R&E benefits, or based on another relationship that reasonably relates the cost to the benefit. The guidance provides that the allocation method used for one type of cost may not be the same as the allocation method used for another type. So for example, a taxpayer may allocate labor costs by multiplying those costs by a ratio of the total time a person spent on R&E activities compared to their total time on all services. Whereas a different example might be a taxpayer allocating facility costs by multiplying the amount of R&E square footage to the total square footage of a facility. So there are different potential avenues for determining what those Section 174 costs might be in terms of how you go about allocating those costs. For those interested, there is a comprehensive example in the notice covering the areas we discussed in the last few slides. And it goes through some of those different allocations through examples and different departments that might be applicable. And then lastly for this section, the guidance also provides that expenditures that are defined as R&E expenditures must be treated as R&E expenditures. So it's kind of just continuously restating this is required. If you have expenditures that meet the definition of R&E under 174, they need to be treated as such and not treated otherwise. And with that, I'm going to turn it back to Chad for our next polling question.
Awesome. Thanks, Josh. Our second polling question for today, true or false, 174 R&E amortization is only applicable if you claim the 41 R&D tax credit. A, true, or B, false? We'll give you about 25, 30 seconds here to submit your answers. Again, select the answer and hit the submit button. All right, we're about 85% here. Give me about 5 more seconds to submit your answers. All righty, we're going to move it on to the results slide here.
All right, so going through this polling question, the correct answer is false. It's going to be applicable whether or not the R&D credit is claimed. They're two separate and distinct items. So I'm going to turn it back over to Travis now.
Yeah, and I think that polling question, that's a good one. It's a really important one to understand because it's a question that we get a lot. It's like I have companies that have been claiming an R&D credit and now they they figured out that they have to capitalize all of their R&D spend, and in the short term, that translates into a large tax bill. And so trying to help them understand that this is a requirement. It's not optional, only if you're claiming an R&D credit. So now we're going to change topics. We're going to move on to software development. And so in the new Section 174, software development was a term that it was not defined at all. It just said software development had to be capitalized. So we're happy to see that the notice did provide some definitions and also some examples around software. Prior to the Tax Cuts and Jobs Act and the amendments taking effect, many taxpayers relied on a RevProc, and a lot of people aware of this RevProc 2000-50. They relied on that to determine the proper treatment of their software development costs. But the notice made it clear that that revenue procedure is now obsolete. Section 174 is now the law of the land when it comes to how you define software development. The notice broadly defines computer software as any program or routine designed to make a computer perform specific functions. It covers a wide array of software types and their related documentation, including system software, programming software, application software, embedded software, and more. The notice makes a distinction between software developed for internal use and software that's held for sale or licensing to others, and it provides some examples of what should and shouldn't be capitalized. I think one of the biggest areas of focus is that software development includes upgrades and enhancements to existing software. So that refers to modifications that increase the software's functionality or substantially enhance the speed and efficiency of the software. That language around what constitutes an upgrade or enhancement is an area where we are seeing a lot of follow-up questions from clients, and we do expect the government to provide some more guidance on that issue in the future. All right, so the guidance provides some valuable insights into what constitutes software development under Section 174. It identifies key stages of the software development process, and some of those activities include things on this list, but not limited to things like planning the development of computer software, including the identification and documentation of software requirements. And I think that's one where we were getting a lot of questions, and people were unsure and people had different opinions. I think that's one that maybe companies aren't required to capitalize for book purposes. So some were surprised that gets included, others not, but that's where we ended up on that one. Also, designing the software, designing any upgrades and enhancements, building a model of the computer software, of course, writing code, source code, and converting it to machine-readable code, testing the computer software or testing the upgrades and enhancements, and making necessary modifications to address defects identified during testing. But it only includes development up until the point that either the software is placed in service, if we're talking about software developed for internal use, or when you've reached technological feasibility and the software is ready for sale or license, if it's software that you're holding for sale or license. So, I mean, it really encompasses the entire software development lifecycle. It's pretty inclusive in its definitions. And then moving on, turning our attention to activities that are excluded from software development. And they really fall into two primary categories. So we have software developed for use by the taxpayer and its trade or business, so internal use software, and things that wouldn't qualify under internal use software are things like training employees, maintenance activities after the software has been placed in service, as long as they don't give rise to things like upgrades and enhancements. So, for example, corrective maintenance, debugging, diagnosing, fixing programming errors, things of that nature. And there's still sort of a gray area on what constitutes maintenance. Another one there is data conversion activities, except for activities to develop computer software that facilitate access to existing data or data conversion. And then installing the computer software on a computer, that's one that's not going to count. Then we have the following activities with computer software that's developed for sale or license. A lot of our SaaS technology clients and taxpayers. Some of the things that would not be capitalized are activities that occur after the software is ready for sale or license, such as marketing, promotional activities, maintenance, again, maintenance that does not give rise to upgrades and enhancements, distribution activities, and customer support activities. So, again, maintenance is the one where we're getting a lot of questions, and I think we might see additional guidance from the IRS. If it's anything deemed quality control testing is specifically excluded. And so it's a pretty comprehensive list, but there are a lot of questions around is it, if you release a version, is it the first version you release? What about the follow-on versions? And if you're releasing, once a week or once a month, and some of those releases include minor enhancements, where do you draw the line? And I think that's something that we're trying to get worked out. All right, so then, how does this apply to purchase software? So in the case of upgrades and enhancements to purchase software, the activities treated as software development that we just went over, those are all applicable. The purchase and installation of software, including configuration of pre-coded parameters to make the software compatible with business, and also re-engineering the business to make it compatible with the purchase software. Also, any planning, designing, modeling, testing, or deployment activities with respect to the purchase and installation of that software. Those aren't activities that constitute software development for purposes of Section 174. And this kind of falls in line with the IRS's approach to ERP systems. I think it mostly comes into play when a company purchases software off the shelf, and then they spend a ton of time and money configuring that software to meet the needs of their business. In most of these cases, you would not be required to capitalize those expenses. I'd say, however, if it does rise to the level where you're making significant modifications and you're having to write code, then you might have a different answer. But the treatment of this is kind of in line with the IRS's view on internal use software for the R&D credit, and where ERP installing off the shelf or ERP systems generally is not viewed favorably for credit purposes. All right, over to Chad for our next polling question.
All righty, thanks, Travis. And our third of 4 polling questions today: does your company or client have a software development activities under 174? A, yes; B, no; or C, I don't know. Give you a little time to submit your answers before we go into the results. All right, right about 80%. Give you about 5 more seconds to get your final answers in. All righty, moving on to the results slide. Back to you, Travis.
All right, looks like nearly half of the people on this call, this webinar, have software development expenses. So I'm glad to see there's a balance, and that we covered that topic. And look out for future guidance on these issues that we talked about, like maintenance and where we draw the line.
All right, so moving on to research performed under contract. This is another area where taxpayers had a lot of uncertainty regarding Section 174 treatment. But essentially, the guidance provided some new terminology, some of which is shown here on the slide. But the first is the research provider. So this is going to be the entity that is directly engaging in the R&E activities and is contracted by the research recipient for such R&E. As alluded to, the research recipient is the entity that contracts with the research provider for the R&E to be performed. Both parties to the agreements would need to evaluate whether their costs are applicable for Section 174 separately, and they could be both needing to capitalize the costs for the same R&E product. Another important term added in the notice is financial risk. This is a risk that the research provider may suffer a financial loss related to the failure of the research to produce the desired R&E product. So starting with the research recipient analysis, this treatment for the costs paid or incurred by the research recipient is governed by the existing principles in the 174 regulations. So we're going to be looking at the -2A section of the 174 regulations, where we know that 174 applies to expenditures paid or incurred for R&E performed by another entity on the taxpayer's behalf. However, expenditures are generally not going to be R&E to the extent that they are for the acquisition of land or depreciable property used in connection with that R&E. Under the -2B3 regulations, though, if the expenditures for R&E are incurred in connection with the construction or manufacturing of depreciable property by another entity, they are considered under 174 if made upon the taxpayer's order and risk. Section 174 would not apply if the taxpayer purchases another's product under a performance guarantee, or for any part of the purchase price of a product already in regular production. So when we look at the research recipient, we are still looking at the existing regulations under Section 174. However, if we go to the research provider, we have a new guidance that provides essentially a two-pronged analysis. So first, if the research provider bears financial risk under the terms of the contract, then the costs paid or incurred by the research provider that are incident to that R&D are going to be considered under Section 174. And as a reminder, financial risk is the possibility that the research provider may suffer a financial loss related to the failure of the research. The second part of that analysis is that even if the research provider does not bear financial risk, but has a right to use any resulting R&E product, then the costs paid or incurred by the research provider that are incident to the R&E are again still included in Section 174. The guidance provides that a research provider will be considered to have rights if it has a right to use any of that resulting R&E in its trade or business, or otherwise exploit any of the resulting R&D through sale, lease, or license. A research provider will not be treated as having a right to use the R&E product if the right is available only upon obtaining approval from another party to the research arrangement that is not related to the research provider. And then lastly, the retention of mere know-how gained by the research provider in performing those services is not considered a right to use or exploit the R&E. So kind of to recap the different scenarios, if the research provider is at risk, the expenditures incurred for R&E are going to be Section 174. If the research provider has rights to use the R&E in its trade or business, otherwise exploit it. The expenditures are going to be 174 for the research provider. If the research provider has both rights and risks, again, still going to be under section 174 for the research provider. The only time the research provider isn't going to treat research expenditures as section 174 is if the research provider is not at risk and has no rights. In this case, the expenditures may be treated otherwise, likely under section 172, or sorry, under 162 or another code section. And then the last point here, it's not going to be uncommon to see double capitalization under this guidance, where both the research recipient and the research provider are capitalizing costs for the same R&E product. So for example, payments made from the research recipient, where the research recipient has the financial risk, but there's shared rights in that R&E. In that case, both parties would likely have section 174 R&E expenditures to capitalize. And I'm going to pass it back over to Chad for the last polling question.
Awesome. Thanks, Josh. And our fourth and final polling question of the day, what is your prediction on 174 legislation? A, R&E amortization is here to stay for the foreseeable future. B, retroactive legislation will pass following full R&E deductions for 2022 tax years and forward. C, legislation will pass allowing full R&E deductions for 2023 tax years and forward. Or D, I gave up trying to predict R&E legislation. We'll give you a little time to answer that. The final polling question here. All right, give you about 5 to 10 more seconds before we move on to the results. All righty, move it on over.
It's an interesting mix. I myself am probably in the, I gave up trying to predict what's going to happen, or, you know, having 15 to 50 different options that weren't listed here as what the potential outcome might be. Travis, any thoughts on the results here?
I think, yeah, my answer would be D as well. I wanted to touch on this here if we have some time at the very end, but I do understand the view of the first one. It's here to stay for the foreseeable future, and we could talk about those different scenarios here if we've got time at the end.
Yeah, it's interesting because I think, you know, 37% or 38% saying it's here for the foreseeable future. I think if we did this a year ago, it would have been a lot lower, but it's interesting to see how we've evolved over the last year.
It is. All right, so this last section here of the presentation, it impacts maybe a smaller subset of our clients, but they are important areas that were addressed in the notice. And so I'm just going to touch on them at a very high level since we're kind of running short on time here. So what happens to your unamortized research expenses if the company is involved in one of these disposition, retirement, or abandonment scenarios? As I mentioned earlier, that's where we were getting a lot of questions on that, and people were really hungry for guidance. And the answer to that question really does depend on the type of transaction that's involved. The notice addressed some of the more common transactions. And so I think what they did was kind of simplified it. I don't think it covers every type of scenario, but scenario one, if a taxpayer disposes of, retires, or abandons their SRE property during the amortization period, then the taxpayer will just continue to amortize those expenses over the remainder of the amortization period. That's true even if the taxpayer ends up selling the property at a loss. There's no adjustment to basis or anything like that. Scenario 2, that's where if a company merges or gets acquired by another company in a 381 transaction, then the acquiring company will continue to amortize the research expenses of the acquired company over the remainder of the acquired company's amortization period. And then scenario 3, so if a company dissolves or they go out of business, then that's the only time where the company can deduct the remaining unamortized research expenses in its final taxable year. But that doesn't apply if the sole purpose of dissolving or going out of business is to claim a deduction for the unamortized research expenses. So also keep in mind that these rules apply to corporations, not partnerships. The situation is a little bit unclear for partnerships until hopefully the government issues some further guidance, or those companies will just have to rely on some of the existing authorities to determine a reasonable approach. All right, so long-term contracts. So the notice is proposing changes that could really have significant implications for companies that engage in long-term contracts or they're operating under the percentage of completion method. So this is a lot of construction companies and even some software developers. We have an entire team that does that type of work, R&D or R&E work for those types of companies. But essentially, taxpayers, they have to include the full amount of their incurred research expenses in the numerator of that percentage of completion ratio, which increases the contract price that has to be recognized as income. However, it presents a scenario where they can only deduct the research expenses that they're amortizing, and that results in a significant mismatch between the income and expenses, and could create a significant tax liability there in the near term. So yeah, this new guidance, it would address that mismatch. It would allow taxpayers to include only the amortized research expenses in the numerator of that percentage of completion ratio. And that would result in a more accurate reflection of the taxpayer's income and expenses. One of those areas where the government's requesting some additional feedback, and we might see some additional guidance on that. Finally, I'd like to just briefly touch on how the notice addresses cost-sharing arrangements. So I think the important thing here is that right off the bat, the guidance only applies to participants in a qualified CSA, cost-sharing arrangement, that would meet all of the relevant administrative requirements. It doesn't apply to everybody with the cost-sharing arrangement. So I think that's where you need to go in and verify whether this specific guidance applies to your arrangement. And yeah, it appears that this type of arrangement isn't common within our client base. So I'm going to leave it at that here in the interest of time and move on to our wrap up. All right. So let's revisit some of the key takeaways and touch on just a few recent developments in the next couple minutes. So first, we've gained clarity on 174 activities. Some questions are still unanswered, but we're optimistic that many of those are going to get addressed in either the proposed or the final regulations after the government receives several rounds of comments. Second, activities that only support research activities indirectly, such as those by G&A departments, that Josh mentioned, are not required to be capitalized. So that's good news. Then the IRS does not consider maintenance to be software development, but pay close attention to upgrades and enhancements. Number 4, if you perform research under contract, it's essential that you review the terms of those agreements and determine which party or if both parties have to capitalize under 174. And just in terms of recent developments, a couple things to mention. First, there is broad bipartisan support in Congress to repeal 174, even retroactively. but the current political environment poses significant challenges to getting that done. I'll leave it at that. The IRS also plans to release procedural guidance by the end of the year for accounting method changes. And then finally, they're looking to provide more detail on how to differentiate between upgrades and enhancements of software versus routine maintenance costs. With that, 11 o'clock, this concludes our portion of the presentation. Thanks for joining us today, and back over to Chad for some final comments.
Thanks, Travis. Thank you, Travis and Josh, for a great presentation today. If we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certification is available for download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.